I want to bring in Northlight Asset Management Chief Investment Officer Chris Zaccarelli. Chris, and with markets continuing to hit these record highs, what do you think this means for the rest of the year? When everybody comes back next week, summer is over, it's after Labor Day, the trading desks are going to be full. Do you think we're going to see a little more volatility in the markets as we get ready for the Fed's meeting?
Yeah, I think that would be typical. If you look at historically, September is the worst month on average, and clearly, those stock market crashes that we've had, the most infamous ones, have happened in October. So it is typical, from a seasonal basis, to expect a little bit of volatility in September and October. Of course, right now there's a big question about whether or not the Fed will cut in September. We believe they will. I think consensus is that they're going to cut. But in order for them to do that, they're going to have to see some inflation numbers, not only this morning, but also again on September 10th and September 11th in advance of that next meeting. And as long as inflation is within check, within reason, we think they can go ahead and cut rates. But if inflation runs a lot higher than anyone expected, a rate cut could be off the table. And again, you never know what will be the catalyst for some market volatility, but this is clearly a big event that a lot of people are watching. All
right, so July, let's take a look at yields right now this morning as we get ready for the Fed's preferred inflation measure, July PCE, 8:30 a.m. Eastern time. And this really is going to be quite a report. Economists are expecting a monthly rise of 0.2%, a 2.6% number year over year. That's the estimate anyway. But yesterday's read on second quarter GDP showed the economy expanding at a stronger than expected 3.3% pace. That was strong consumer spending and a lot of the AI investments that we've seen, Chris. Markets already pricing in, as we've talked about, that Fed rate cut. Is there the potential that today's PCE number could change the Fed's direction? And I say that because inflation at this point still is well above that 2% target. The markets have been expecting this rate cut, but we're still above 2%. So the Fed might be in a little more of a precarious position unless, sorry, long question, unless Powell decides to focus more on the employment picture and not inflation.
Yeah, and I think you framed that really well. I mean, that's exactly the situation. It does seem like Powell, since his recent testimony in Jackson Hole, is focused a little bit more on the employment picture. And so with a softer jobs number next week, that could be one thing which would tip the Fed much more strongly towards cutting rates. On the other hand, if inflation comes in much higher than expected, that is a possibility that they may be a little bit more concerned about cutting and may pause. We do think they're putting more emphasis on the employment report. We do think that even if inflation runs a little bit hotter than usual, the Fed having to choose between the two, at least at this point, might choose a labor market. And I think that's why consensus is saying a 25 basis point rate cut is most likely going to happen in September. What we're really interested in is what will have to happen after that. And really, that's where we're looking at the data, not just this morning and into the next week, but in the next coming months. If inflation runs a little bit hotter in the short run, but then starts to cool off, I think you could see more than one rate cut before the end of the year. Unfortunately, if inflation does run a little bit warmer and continues to go higher throughout the rest of this year, we may see one and done for 2025. So that's really what markets are looking at. And you could really see some impacts from that, both in the stock and bond markets, of course, depending on what the Fed ends up doing over the next couple months.
No, I don't think the markets are going to take that well. But Chris, just real quick, I got about 20 seconds. We did get commentary that they were saying that they were going to have to raise prices. And I'm looking at a Walmart, a Target, but there's many other companies that have said the same thing.
Yeah, I think that's right. I mean, but I think ultimately companies have a lot of levers to pull. They can raise prices in some areas, cut prices in others. They can also look to spread those costs across their entire lineup. So just because they're seeing inflation in certain pockets, they could raise a little bit lower in those areas, and maybe take a little bit of a hit to margin in certain part of their product lineup, and then raise across the board. So we're seeing companies deal with the tariff problem and with increasing prices with different strategies. And so far, a lot of the increase in prices that companies have seen have not been passed on to customers as much as was originally feared earlier this year, which is why you're seeing the market at all-time highs.
Right. No, absolutely. And we've been tracking that as well, because the tariff, the numbers that we were first presented in April aren't the numbers that we have today. That's a great point. Chris Zaccarelli, it's great to see you. Thank you for being here.
Thank you.